what would you describe saving as? How would you define it?
I think it means a lot depending on where you are. So for me, saving is not spending money. So at the end of the month, you have some money aside. Savings in most people's mind is something that is short term. And I think the piggy bank is such an important metaphor there because it's exactly what it is, right? Saving is a piggy bank. The real problem comes down to is like, what are you doing with your savings? You should be aiming for about 20% of your monthly income should not be spent. You should be saving that, and then obviously doing something with that. Obviously, if you're sitting at 10% of saving on a monthly basis, you should be doing better. You can be doing better, and obviously, the more you can do, just creating more opportunities for growing wealth and realizing financial freedom.
What is investing? How would you define investing, and how would you differentiate it from saving?
So it is important. Like for me, investing is actively doing something with your money. So you're putting your money into a place where you want it to grow fundamentally. Yeah, 100%. I think you hit the nail on the head. It really comes down to goals. And I think that an emergency fund is a goal that everybody should have. Not only that, but it's once you've achieved that, it's sort of like a goal that you can tick. But then it still remains there and remains as a sort of a support base as you expand your ambitions to include other goals. And I think what's important is that every goal can and should have its own strategy, right? So it's like, okay, what's the time horizon of this goal? Is the first question. Is it a short-term goal? Is it a long-term goal? So I think if you were to think about where you should save, it's like, are you getting an attractive interest rate? Can you access that money in 1 to 2 days? And
hello, everyone. Welcome to another episode of Frankly Speaking, where we speak frankly about managing your money and investing. My name is Cassidy Nydahl. I'm head of growth at Franc, an investing app that's making investing simple and accessible to more people. If you like what you see or hear, please subscribe for future episodes. We have them coming out every other week, every month. And if you want to find out more about the Franc app, check our description in the description box below. We link out to our website and you can find out more about what we do and how to get started investing. With me today, I have Thomas Brennan, co-founder of Franc and CEO. Welcome, Tom. As I mentioned earlier, I can't believe it's taken me this long to be in a Frankly Speaking episode with you, but I'm really excited to chat about our topic. And our topic today is saving versus investing. And we were also just saying, Tom, that those are two words and phrases and terms, I guess, that we throw around quite a lot in the financial world, at Franc as well. But they're not necessarily interchangeable. They're obviously very different ways of dealing with and putting your money aside. And I think it's really important, and it's a question that we get a lot from our investors. What is the difference between saving and investing? When should I save? When should I invest? What does good saving look like? What does good investing look like? How does that factor into my financial mix? So that's what we're hoping to discuss in this episode today. And we're going to end off with a bit of a cheat sheet of, when you should save, when you should invest, so that you can allocate your money accordingly to make it most effective for your goals. So, Tom, I'm going to start with, I guess, quite a basic question just to set the tone. What would you describe saving as? How would you define it?
I think it means a lot depending on where you are. So for me, simply saving is not spending money. So that means you are not consuming. So at the end of the month, you have some money aside. And then it's a question of what you do with that. Savings in most people's mind is something that is short term. So it means that you can access your savings in case of emergency, which means you've got it readily available. So saving effectively inherently has a sort of a short time horizon. It's sort of, I want to have a little bit of cash available that I can access really quickly. And obviously you want to build up a little bit of a nest egg or a little bit of an emergency fund in case you need, in something that can, allow you to access your savings as and when you need. So yeah, for me, it has sort of two implied meanings. One is you're not spending. That is saving. So not spending is saving. It's the opposite of spending. And then the second meaning is that you are putting that money into a place where you can easily access it.
Feels like the most basic thing that you can do with your money, right? Like putting it in a piggy bank when you're a kid. You start off your money journey, should I say, with saving, rather.
And I think the piggy bank is such an important metaphor there because it's exactly what it is, right? Saving is a piggy bank. It's something that you put money aside. You can't touch it. Obviously, you're not going to be going off and buying any seeds. But it also means that when you need to access the piggy bank, you can. It's sitting on your bookshelf or above your bed if you're a kid. And obviously, as you grow up and become an adult, it can be a little bit more sophisticated, and it can actually do something for you. It doesn't have to just be cash sitting idly, whether that's in your bank account or under your mattress. You can actually save in something that is going to give you a really attractive interest rate, like the cash fund, with the Franc app. That for me is a very good place to save, because not only can you access your money when you need it, but also it's actually generating a return for you.
You talk a lot about that accessibility, so being able to access your money at essentially like the drop of a hat. And I think that's so important and something for us to emphasize. Where do you think savings should lie? Preferably, I'm assuming not in a piggy bank where it's not growing, where you can access it very readily if you need it.
Yeah, so for me, it really comes down to something that can give you an attractive interest rate and where you can access your money. For me, that's what I look for when I look for a really good place to save. And obviously the convenience of being able to get the money in and out. So those would be 3 criteria for you to consider. Obviously, if you leave your cash sitting in your bank account, sure, you can access it really conveniently through your banking app, but you're not earning any interest. So actually that you're losing value of money over time because of inflation. So I think if you were to think about where you should save, it's like, are you getting an attractive interest rate? Can you access that money in 1 to 2 days? And is the way of accessing that money convenient? You obviously don't want to have to fill out a form or call somebody or do something like that. You want to be able to, access that money conveniently, simply, hopefully through, app on your phone. And truth be told, I think the Franc cash fund can do exactly that. It's convenient. It's earning you a really good interest. And you can access it 24/7.
So I know saving is something that you're particularly passionate about, and it kind of became the foundation of a lot of what you did at Franc and why Franc became what it is. Could you give us a few of your thoughts around the savings culture in South Africa and where you feel it's at and where you think it needs to be before we go into investing?
I think it's a lot of people don't think that there's a good savings culture. From what I've read, from what I've learned from discussing to many people, actually a lot of people do save. They may not have a lot of money to save because they don't have a lot of income, but generally the savings rate is between about 10 and about 25% of monthly income is being saved. The real problem comes down to is like, what are you doing with your savings? Well, some people are putting it, leaving it in the bank account, putting it under the mattress, or putting it in a stokvel with other people. That tends to be the behavior of people saving. So for me, obviously I'd want people to save more. We've spoken about before, and I'm sure you've spoken about it on the Frankly Speaking podcast, the sort of 50-30-20 ratio. So which means that you should be aiming for about 20% of your monthly income should not be spent. You should be saving that. And then obviously doing something with that. Obviously, if you're sitting at 10% of saving on a monthly basis, you should be doing better. You can be doing better. And obviously, the more you can do, you're just creating more opportunities for growing wealth and realizing financial freedom and achieving your financial goals. So I think there's a dynamic around like how much of your monthly income are you successfully able to budget and pay for your expenses, your necessary expenses, your luxury expenses, and how much are you not spending? How much are you saving? But the real kind of, real passion of mine is helping people realize that they can save in a better way, right? Again, going back to those 3 points, it's like, are you earning an interest? Is it accessible in 1 to 2 days? And is it convenient? I think those are really important. And I think a lot of people are failing on either one of those or all of those dimensions. They're not earning an interest. They can't access their money. And the way in which they have to manage their savings is a very painful process. So then it holds them back from doing it, more frequently, more readily, etc.
Which I think segues very nicely into the next question, which is what is investing? But before I go into that question, I want to ask our audience, whoever's listening or watching, if you are still watching at this point, are you saving? And if you are saving, pop in the description or the comments below, yes, I'm saving, so we can see what, by show of hands, how many of our audience are actually saving. Which brings us then to our next question, Tom, which is what is investing? How would you define investing, and how would you differentiated from what we've just spoken about, which is saving?
So it is important. Like for me, investing is actively doing something with your money, right? So you're putting your money into a place where you want it to grow fundamentally. If you were to consider investing as simply the act of not spending money, then investing is kind of the other side of the coin. You say, okay, well, what do you do with that money? I would argue that, putting your savings into a money market fund, some might consider that investing, but for me, that's just a better way of saving. It means that you can access your money and all the things that we've spoken about. So, I want to encourage people not to be intimidated by investing, right? Because investing, I think, is a word that a lot of people are unfamiliar with. Like, what is investing? What do you do with money? How do you invest? All of these types of questions are new concepts, right, to many, many people. So investing for me is like, okay, you're doing something with your money. You're putting it into a place where you want to see growth. And then it comes down to, obviously, there are a range of different things you can do, right? There are things that carry a lot of risk. So buying a lotto ticket, not that that's investing, would, some might consider that investing because there's a chance that you can win big. Investing in a money market fund is very low risk, right? It's equivalent to leaving your money in a bank account or putting it in a savings account with the bank. It's that level of low risk. And then obviously there's a whole bunch of stuff in between. So yeah, maybe pause there. I think investing is doing something with your money. And then the decision comes down to like, okay, well, what am I trying to achieve? What are my goals? Different goals have different strategies, which would help you inform how you want to invest your money. Like, what are the things that you want to put your money into to expect a reasonable return in line with your ambitions?
So from what you're saying, it feels very much like the fine line between saving and investing is very much that concept of risk and potential return, right? So you've mentioned a lot about, the fact that when you're saving, you want to get some kind of return, but you want to have it easily accessible. You don't want it to be very risky because of that access. You want to be able to access it at any time and make sure that it's still growing at that point. It hasn't gone down. Whereas when it comes to investing, maybe talk to us a little bit about risk there. What is risk in investment? How much of that you take on in your investing? How that differs to when you're saving.
And again, I think risk is something that a lot of people are, it's an unfamiliar concept. I think a lot of us implicitly understand it, but it's difficult to practically put it into a relationship with what you do with your money. I think the best way to think about risk, yeah, exactly. Like, I don't want any risk. The best way to think about it is to think about its relationship with time, right? So bear with me. We're going to play a little bit of sort of like a mind game, right? And we're going to use the risk of rain, right? Everyone knows the weatherman who comes on and says, the chances of raining today are like whatever. So now imagine rain implies that you lose your money, right? Hypothetically, if you wanted to access your money tomorrow, would you put it into something that is exposed to that risk? No. Fundamentally, no, right? You want to make sure that your money is going to access, and you don't want to play the odds of whether it rains or not, having an impact on whether you can access your savings. However, if you're willing to kind of like, roll out the time window, and you have the option of saying like, okay, well, I'm going to access my money at some future point in time, and I'm going to choose the day when it's not raining. You're pretty sure that, in a long enough time frame, even if it's middle of winter in Cape Town, for example, there's a chance that you're going to have a sunny day, which means, okay, now's the time where I can access my money. I'm not going to be hit with sort of any sort of like negative penalty. So the relationship with time and risk, I think, go hand in hand. The longer your time frame, if you're looking like 5 years, 10 years, saving for retirement, like, 40 years out, you really are expanding your capacity to carry risk, because you have the option of being able to make a decision about where you want to realize, kind of, take your money out. And that underneath that, for people that obviously, I'm going to leave the metaphor of rain behind, risk fundamentally has to do with the rise and fall of uncertainty of stock prices. The market goes up, prices, the businesses are doing well. Everyone's really excited about it. You may have heard of the expression of a bull market, is when sort of there's a lot of enthusiasm. The flip side is when people get nervous and anxious and cautious, and they call it a bear market, when typically prices drop. So you've got this like world of uncertainty where prices are going up and prices are going down. And that's the same with property prices, stock prices, share prices, you name it. So it's how you operate within a world where you do have this volatility, this variability in price. And obviously, if you're looking out, over a long timeline, again, you have the opportunity of realizing your investment at the time in which it is better for you, right? You don't have to pick that rainy day. You have more chances of being able to kind of realize a positive return. So that's hopefully a simplified version in my mind of how sort of like risk and time go together. The longer your time frame, the more risk you can take on board, and the shorter kind of time horizon you have, the less risk or no risk you should be looking out for.
So we're talking a lot about risk, but I guess as a potential investor, somebody who wants to look into investing, my question is going to be, well, why do I want to take on any risk whatsoever? And I think what we're maybe missing here is that point that with additional risk, more often than not, also comes the chance of more return. I don't know if you want to talk more about that.
No, I think it's really important, and thank you for pulling it out. I think everyone talks about the risk-return ratio in the investment world, and it really means this relationship between risk and return. Typically, higher the risk, the higher potential return. Lower the risk, the lower the return. So, if you're going for something like the money market, for example, which is very low risk, the return is still better than a savings account. Let's just put that aside, but you're looking at sort of about 8% or thereabouts currently in the market. If you were to invest in the long term, for example, in the offshore funds, the S&P 500 tracking the top 500 largest companies in the US stock market, if you're looking over about a 10-year period, you're probably going to be looking about between like 10 and 15%. Over the last 10 years, for example, it's been averaging, I think, about 15 to 17%, which is double what you would get if you left your money in the money market. So obviously, from an investing perspective, if you are thinking on a longer time frame, there is an opportunity for you to have a greater return, to grow your money, double, right? To double your investments, which is really attractive, right? The question then comes down is like, what are your goals? Do you have an emergency fund? Like, that is a very important financial goal that everybody should aspire to achieve. Once you've got that set up, right, then it opens you up to more opportunity, and hopefully you feel confident to be able to take on some risk, knowing that you've got a nest egg, right, supporting you in case of emergency. So then it's like, okay, well, why don't I think in a 5-year time horizon, right? Why don't I think 10 years out? And obviously encouraging people to think, why don't I think for retirement, which is, 30, 40 years out, depending on how old you are.
Which brings me to my next question. But before I ask that, I'd also like to know if the audience that are watching or listening are investing, in which case, please, in the comments below, just say, yes, I'm investing, so that we can see how many people are saving, how many people are investing, which then takes me to my next question, which is, should you be saving and investing, which you've half answered, Tom, but I think we can maybe expand that a little bit further. Like, what should you be saving for? What should you be investing for? Should you be on a month-to-month basis putting, money in a savings account or a cash fund and money in maybe a slightly higher risk investment? And for what kind of goals? I think goals really help maybe make it more palpable what exactly you should be saving and investing for.
Yeah, 100%. I think, you hit the nail on the head. It really comes down to goals. And I think that an emergency fund is a goal that everybody should have. Not only that, but it's once you've achieved that, it's sort of like a goal that you can tick, but then it still remains there and remains as a sort of a support base as you expand your ambitions to include other goals. So to answer your question, yes, I think you can be saving and investing, But by saving, I'd say your goal there is to set up an emergency fund, right? So like, okay, I want to put some money aside to achieve, a short-term goal. You can also have other short-term goals. I think, emergency fund is not the only short-term goal. You could also have, I want to go on holiday at the end of the year with my family, or I want to have a really nice, Christmas celebration or a really nice birthday party or an engagement party, whatever the case may be. That for me is a savings goal because it's short-term. It's probably less than a year, which means that you should and can be putting money into a particular pot. This is dedicated for, end of the year groceries or end of the year holiday, whatever the case may be. Those are savings goals. And obviously you can have many. I do believe that everyone should have, say, an emergency fund all the time, right? You always should have a little bit of cash you can access in case of emergency, and that you don't touch that, right? You're not going to go buy a TV with your emergency fund. Like that's not its intended purpose. But thinking long term then allows you to have other goals, right? Do you want to buy a house in a few years' time? Do you want to buy a car? Do you want to renovate your house? Do you want to buy a house? All these things are longer term goals. And because they're longer term, as we've discussed, have an opportunity of having a different investment strategy and one that could possibly expose you to a bit of investment risk. And again, do so appropriately, you don't have to be no risk or all risk. You can have a combination, which means you can have a little bit of cash and a little bit of something which has more investment risk, like investing in the stock market. That can be a combination. Maybe 50-50 is a right mix of cash and equity for a goal that's maybe, 3 years out. I think everyone has goals, I think, and that's fantastic. People are goal orientated, and it's a really nice way to kind of like have a little pocket in your mind, like, okay, I want to achieve this. And so bringing it practically back means like, in your budget, if you want to break down like what's happening with your monthly income, you've got your like, your necessities, your food, your housing, everything, healthcare, whatever. You've got your luxuries, and then you've got that 20% that you should be saving for. Think about the goal sitting underneath that. So it's like, okay, well, what are you going to do with that 20% of your savings on a monthly basis? I've got these savings goals. I've got these long-term goals. Sometimes you might increase or decrease how much you want to put into them. Like, I don't have an emergency fund. It's recommended maybe that, you have about 3 months of your expenses in that emergency fund. So like, okay, let's get that set up first. So I'm going to dedicate all my 20% of my savings in the first month of saving to putting that emergency fund and getting it up and running. Once you've ticked that box, and it's like, okay, do I have a savings goal for the end of the year? Do I, have children? Do I want to kind of start preparing for the long term for their education? I'm very passionate about the subject, as you can tell, and I think it's important that people have some, just think about what are the important things for them, right? And even if they have short-term goals, they don't devalue the long-term goals, particularly because it takes time for money to grow. So you don't want to just enjoy a good holiday at the expense of having a good retirement, right? Or at the expense of educating your children, or at the expense of buying a house. So there's no reason why you can't sort of satisfy both by putting a little bit of money into each of those goals.
I think when I first started at Franc, that's what I loved most about the Franc app, which was the fact that the investing and I guess on the flip side was the cash fund, the saving was goal-based, because then you can have those short-term goals top of mind, but you can also have long-term goals top of mind, right? So you have that wealth goal in front of you, and it's a reminder of, hey, yes, you have that holiday coming up in a few months, but also you need to be thinking about your future wealth or your retirement or your child's education, for example. And you can very, very intentionally put money towards very specific things as opposed to just always putting it away and not really having that motivation there. So I think that ties really nicely in with this idea of saving and investing. Always a goal, short-term, long-term, but make sure both are covered on both in your financial plan.
Yeah, exactly. And then obviously, if something changes in your life, like you get married or, you have a child, you're just adding another goal, right, into the mix, which would be like hypothetically investing for their future. And I think what's important is that every goal can and should have its own strategy, right? So it's like, okay, what's the time horizon of this goal? Is the first question. Is it a short-term goal? Is it a long-term goal? And then second is like, okay, well, what are the other things that I'm doing? What is my state of personal finances? How risky can I be for this new goal, right? Based on the time horizon of that goal. Like that's the sort of the way of thinking about how to add a new goal to the mix, and obviously what you should be doing with the money that you dedicate to that goal on a monthly basis.
Great. I think that's a really great place for us to wrap up. It's been a really interesting chat, Tom. Thank you so much. And I think our audience, I hope, and I'm sure, got a lot of value out of that, really helping to differentiate saving and investing and understanding where both kind of fit into your financial plan and your financial journey. If you did like what you saw or heard, please, another reminder to give us a like and a comment. We'd love the feedback. If you have any other topics you want us to talk about, let us know. As I mentioned, we're coming out with this every other week, and we always have more to talk about when it comes to managing your money and investing. And hit the subscribe button so that you know when our next episode is out. Tom, thank you for joining me in the studio. I hope to see you again here.
Yep, we can do this whenever we want.
And with that, I'll wrap up. Have a great day. Cheers, guys.